Australia's housing slide is deepening as prices fall across most parts of the country and Sydney. Nine's finance editor Ross Greenwood explains how this impacts concerned property owners as well as first home buyers.
House prices continue to fall across the major capital, Sydney falling the hardest over the past 12 months, and it's suburbs like this one at Ryde that are really feeling the greatest pinch right now. The reason for it is, in many cases, there's been a lot of development, so speculation that prices would continue to rise. In fact, these are some of the places where the prices have risen the most in the past. But certainly those people who are keeping check of these numbers say this might not be the last of the house price falls.
We probably should be looking forward to further value falls across the Australian housing market. If we do see values falling further from here, there's a high likelihood of that, it will start to affect consumer sentiment.
Among those who will be most concerned could potentially be mortgage insurers. Surprisingly here, the message is a little better. They say that price falls were inevitable.
Overall, it's not surprising. Arguably, it's predictable. And in the medium term, that should be good. It will give opportunities for those first home buyers.
Of course, the Reserve Bank makes an interest rate decision tomorrow. That's in the wake of a decision by Westpac last week to raise mortgage rates by 0.14%, a move that many people say will only accelerate the house price falls.
Westpac remains an outlier from the rest of the big four banks after hiking its home loan rates yesterday. Westpac boss Brian Hartzer batted away criticism, pointing to the smaller banks, many of which have already hiked their rates. There are two tiers of banks in Australia, the big four and then the rest. And the tier you're in partly dictates how expensive your funding costs are. There are now serious doubts about whether the big four should continue receiving their favourable treatment. Here's Michael Yander.
Another one bites the dust. From its very first fortnight of hearings, the Royal Commission has been a disaster for the major banks. But the Big Four still hold more than 80% of the mortgage market, and there's a good reason why.
All else equal, if someone's walked into, say, a major bank branch versus a regional bank branch for the exact same loan, the risk, everything else is all the same. Except when a major bank looks at it, they get to hold less capital against it, whereas a regional bank for the exact same loan, same risk, has to hold more capital. And so that's where the disadvantage starts to get baked in.
Alright, the moral of this last story is that once the government or the regulators put the major four banks plus Macquarie Bank and the rest of the banks, smaller regional banks, on the same footing, it'll be a more level playing field. And again, the moral of the story of this is that I wouldn't buy any of the four big banks shares, because again, it'll become a lot more competitive soon.
Here's how it works. The bank regulator requires banks to hold high-quality capital equal to about 10% of their loans. But housing loans are considered safer, so banks only need to hold a fraction of that 10% in reserve. The big banks are allowed to determine this fraction themselves, with a floor of 25%. But APRA makes the smaller banks hold at least 35%. On $1 million loan, the big banks might hold $25,000 in capital, a regional bank more than $35,000. The average capital.
What a time to be alive. Except if you have a Westpac loan. Of course, we saw that go up by 14 basis points yesterday. No word from the other banks as yet. Are we going to see them rise?
We've known that this has been a risk for mortgage holders for a while, and that's because short-term funding costs have been increasing. So we have seen Westpac repricing its mortgage books, which basically means they've increased the interest rates on their loans by 14 basis points. The key here now is to see whether the other big banks follow suit, which they probably will, given that their earnings profile at the moment, there's a number of significant headwinds. If we do see a repricing of books, that will boost earnings by 2 to 4%, and that will help to secure and underpin that dividend payment that's so crucial to the bank share prices.
We're almost...
But most Australian company profits are dictated by the state of the Australian economy, and while JB Hi-Fi shone, rival retailer Harvey Norman struggled, with profit down 16%, not helped by an ill-fated foray into the dairy industry. And with house prices on the slide, there were warnings from Commonwealth Bank, mortgage insurer Genworth and energy provider AGL over rising people struggling to pay their bills.
And then we had Mirvac come out and drastically reduce the number of lot sales they expect to sell in the year ahead. So that means less construction work and less building work for the building industry, which is the third largest employer in Australia.
Prudential controls and other factors have helped cool the housing market now. Does Labor have to follow through on the negative gearing changes?
You were committed to them. They're necessary.
Is it responsible, though,
Absolutely.
given that we're already seeing housing come off?
Not only is it responsible, it would be irresponsible not to. Yes, there's been some heat coming in the housing market. Sure, absolutely. But let's not pretend that, one, housing affordability has been fixed. Still plenty of young people in particular struggling to get into the housing market. Let's not pretend that the budget's been fixed. I mean, negative gearing is the most generous tax concession in the world for property investment. Now, that's another area of the budget which is unsustainable going forward.
What about winding negative gearing back to, say, just one property or two properties?
Well, we considered all that. I mean, we didn't just, pull limiting it to new properties out of the air. We considered all those options. But the one which most targets negative gearing where it's needed is the policy option we've settled on, which is to say, one, importantly, all existing investments grandfathered, so that's less of a shock to the market. And two, to say if you buy something new, you can get the tax concession which adds to supply. Now, people say, you need negative gearing to add to supply. Well, 93% of it goes into existing properties. How's that adding to supply? If that's your policy objective, you've got a 93% failure rate.
Bill Shorten's promised to reverse Sunday penalty rates within 100 days of... It wasn't that long ago the skies in some of our biggest cities were full of cranes building an endless array of high-rise apartment blocks. But as Australia posts yet another record month of unit construction slowdown, there's no denying the housing boom is on the slide. And that's forcing property developers to reassess their projects. Here's Rachel Papazzoni.